Welcome back, everyone. This is Grace Cavantis and Mike Eklund with Financial Symmetry, here with a second quarter 2021 market update. I think this is the third or fourth update we've done, but the purpose here is give folks a quick update of what occurred in the markets last quarter, and then also talk about any current topics. The goal is to keep it to around 10 minutes, so we will move forward to the first slide. Obviously, the first thing is a disclaimer. Just as a reminder, this webinar or recording is for informational purposes only. If you have any specific questions regarding your portfolio, please contact your Financial Symmetry team as they can help you out. But with that, I'll hand it over to Grace, who's going to talk a little bit more about what happened in the markets last quarter.
Markets looked really strong last quarter, which is exciting considering the past year or so that we've seen. And so you can see that the US stock market did great, 8%. International markets did about 6%, with emerging being slightly lower. Global real estate killed it at 10% last quarter, and then bonds were between flat and about 2%.
Right.
Looking a little bit further back, after the fastest bear market in history in March 2020, we have seen unbelievable returns. So 1-year returns for all markets have been fantastic. You can see in the US over 40%, even emerging markets at 40%, international developed markets and the global real estate markets over 30%, which is just great to see, with bonds being about flat over the past year. But these numbers are fantastic, but if we look a little further out at 10-year returns, you can see a lot more normalized numbers there. But it does stand out that the US has done a lot better than foreign markets. And so Mike is going to tell us a little bit more about that.
Yeah, after looking at this page, you may think, well, why even invest anything but US stocks? Because the US stock returns versus the international markets, real estate, and the bond market was much better. But as the next slide shows here, it really looks at US versus international stock returns by decade. And many don't realize that 3 of the last 5 decades, the 70s, 80s, and 2000s, international stocks actually outperformed US stocks. US stocks outperformed in the 90s and in the last decade, obviously. But that's the benefit of diversification. And that's obviously, we talk a lot about that with our clients. And we'll talk a little bit about international markets in a future slide, but the benefit of being diversified, because you don't know what's going to be the best place to invest over the next 10 years. You know, as a reminder, things have looked very strong in the last 10, but in the 2000s, the US stock market actually had a negative return at the end of the decade. So just another reason for the benefit of staying diversified. Moving forward to the next slide, the information that Grace went through is primarily related to just the broad market, either U.S. companies, international stocks, or bonds. This slide gets a little bit more detail. Those that are Financial Symmetry clients know that we tend to tilt our portfolios towards smaller companies that are cheaper, called value companies, and that tend to be more profitable. So what this slide looks at is over the last year for all stocks in the U.S. internationally. Small companies actually did much better than large companies. So they returned about 58% versus 41% for large companies. So it was better to invest over the last year in what's called small caps. In addition, over the last year, it also value companies, which tend to be a little bit cheaper but don't grow as fast, actually outperformed growth companies. So growth companies are typically your more exciting names, such as Tesla or Amazon, actually underperformed kind of the more boring, older companies that are called your value companies. And for those that invested in small companies that are our value, which we typically do, you see those actually were the best place to be over the last year. And then finally, although it's not a big difference, lower profitable companies tended to outperform higher profitable. We tend to tilt towards higher profitable because studies have shown that companies with higher profitability have higher long-term returns. So that's kind of again more of the details of the areas of the market that did well and not as well this last year. So that I'll turn it over to Grace, and I think the talk of the town these days is inflation and what's going to happen. So she's going to walk through a little bit what's going on, what we're seeing today.
It is. Inflation has been a hot topic lately, both in the news and in conversations. So we wanted to get a slide in here and talk a little bit about it. We've seen higher than normal inflation over the first half of 2021 due to a lot of coming out of a pandemic factors. For example, there's been higher than normal demand for goods and services, and there's also been some supply issues in certain industries. Fortunately for investors, if we look back at this chart over the past nearly 75 years, we can see that there's options for investors that protect us from inflation risk. So the risk that the price of goods and services is going to outpace the value of our dollars. This chart shows that if you took a dollar about 75 years ago and just stuck it in your wallet or in your pocket or under your mattress, right now it would be worth only 8 cents. Fortunately, all the other 3 lines on the chart that are higher show that there's options that beat inflation, most of which with a pretty secure option over the long term. So you can see treasury bills. So that would be kind of like the equivalent of sticking your money in a savings account, has still done better than inflation. Same with commercial paper. But way better than any of those is if you invested in stocks. So you can see the US stock market line there has significant growth over the long term. And that's because companies have something to offer. They are productive, they find ways to be efficient and make money. So if you're concerned about inflation, there are places you can put your money to grow faster than inflation over time. Fortunately as well, predictions for inflation over the next 10 years and even up to 30 years look like inflation is going to stay between 2 and 3%, which historically is right in line with what we've seen in the past and what we're used to. So if you're afraid of inflation right now, you're probably going to be okay.
Yeah, I mean, only time will tell, but obviously the big question is the current uptick more transitory, as you mentioned, Grace, people just looking to spend after being kind of cooped up for a year, or is it more of a permanent? And in the bond market, which I liked as a good predictor, because these are the individuals that are actually investing their money versus maybe the media or a friend or a family member who may have a prediction, doesn't expect, material inflation over the next decade or 30 years. So that's a positive sign. So, moving forward then after talking about inflation. So this is a slide that we have shown every year every quarter we have provided the market outlook. This is actually Vanguard's 10-year forecast as of the end of March 31st, 2021. So forecasts are forecasts. No one has a crystal ball, but we do think Vanguard has a very solid methodology and track record with this. A couple of things I'll note, and not much different than kind of we've talked about in previous quarters, is those returns in the U.S. market over the last 10 years of I think 14 or 15%. Vanguard predicts those returns to be from 2.6 to 4.6%. So obviously, investors should temper their expectations a little bit, given what they've experienced really obviously over the last year, but also the last 10 years as well. The other thing I'll just note on here is they find is the best place to invest today. Well, that happens to be international stocks. It also happens to be probably the worst place to have invested the last 10 years, which is not inconsistent with what we've seen historically. Typically, places that have done poorly are the best places to invest going forward. So they find the international markets the most attractive, followed by value companies, which financial symmetry clients probably know we like to tilt our portfolios towards value companies, is the other area where they expect higher returns than the rest of the market. The good thing is, even with lower than expected equity returns versus historical levels, they do still expect higher returns than cash or bonds. So another reason to stay invested for the long term versus trying to time the market, which is obviously a very challenging task. So to finalize the financial symmetry approach, and obviously talk to your advisor and team about your specific portfolio, but obviously we're focused on areas of the market with the higher expected return long term, and that would be international companies, value companies, and small companies specifically today. In terms of any specific questions, we do have a podcast that we talk in further detail on our investment process. We have the link there, as well as on our website, there's a link to our a white paper of our 3-step investment process. And then finally, probably most importantly, if you have any specific questions, obviously we have Grace's email, myself, and then our website where we have additional blogs and content available for anyone that's interested. But we appreciate you listening this quarter, and we'll be up again next quarter. But obviously, feel free to reach out if you have any questions for us. Thank you.